Hello and good evening, everyone. Today's webinar topic is minimum risk simplify investing for risk averse investors. So, for this, we have with us Mr. Arup Kumar Mukherjee, sir. Sir is the former MD and CEO of India International Clearing Corporation (IFSC) Limited, a subsidiary of the BSC located at Gift City, Gandhinagar, Gujarat, where he has served for over 8 years. Prior to that, Sir has worked as a Chief Regulator Officer of India Clearing Corporation Limited, another subsidiary of BSC, for over 2 years. Before that, Sir has worked for over 2 decades with the NSE in various verticals such as listing, trading operations, derivatives, index services, exchange, compliance, investor service, arbitration, education, and training, etc. Prior to NSE, Sir has worked for around 4 years with the Stock Holding Corporation of India Limited. Arup Sir has over 38 years of experience in the corporate sector, mainly with exchange and clearing corporations. Mr. Arup Mukherjee sir has completed his BCom and MMS from Mumbai University. Now, a short glimpse about NISM. NISM is a public sector trust established in 2006 by the SEBI, the regulator of the securities markets in India. The institute carries out a wide range of capacity building activities at various levels aimed at enhancing the quality standards in securities markets. Before beginning the session, I would like to request all the participants to note some important points. First, question will be taken at the end during the Q&A segment. Second, all participants will receive a participation certificate within 3 to 4 working days. Third, the recording of this session will be available on the NISM's YouTube channel. Now I request Arup sir to begin with the session.
Thank you very much. So firstly, I would like to thank NISM for giving me this opportunity to come and make this presentation in the Investor Awareness Program. And so to begin with, the topic, as you can just see here, is about minimizing risk and simplifying investing. Before that, I will just stop my video and then continue. Minimize your risk and simplify investing. And the topic for today is also for those who are risk averse, conservative investors who are looking at long-term investing, that is saving their money, hard-earned money, and investing it in a judicial manner, not taking too much of a risk, while at the same time having all the other parameters in place, such as diversification, uh, allocation in different asset classes, but trying to minimize the risk and be a conservative investor. What a common man is, that is what we are trying to cover today. And why I thought of this topic is that just a few months ago, one of my friends, though much younger than me, he lost almost around 35 lakh rupees in this WhatsApp scam, the stock market scam, which is nowadays going on. So he got tempted into that, and he got trapped in that, and he lost a considerable amount of money. Educated, he's in the IT sector, IT professional, young guy with growing kids. So I was just wondering what happened. So I was talking to him, and I could realize two things. While talking to him, I could realize two things. First, what I could realize was that, of course, it's a common, trend with us, that we all get tempted, we all get a little bit greedy with quick money, some quick returns, and we fall for it. Initially some tips come and we feel, okay, this will give us good returns, and these tips will keep coming and I'll be making money. So that greed is there. It's a common tendency with a lot of us, and that's what sometimes gets us trapped into these kind of uh, whatever these messages and tips which come. And now this WhatsApp and other social media has become a vehicle for enticing people. That was one thing which I could realize, a common mistake, you can call it. But what I had a little bit tough time to understand was that why did he fall for this trap? He's an educated person. He's been in the IT sector for a long time. He's a qualified man. He has been investing also. So I was wondering, why did he fall for this? Why did he? And in spite of so much news coming up, so many alerts, like this news we have 200% returns promise, rupees 2.5 crore lost. What made Mumbai's logistic firm owner for stock market scam? And as you can read here, he was initially contacted through WhatsApp groups by individuals posing as stock market experts. So this has become a common thing. And one wonders that why do people fall for these scams or these traps? Because there's so much of news, so much of alerts being given by the exchanges, by the regulators, so much information available. Still, people fall for these kind of you know inducements or whatever you call it. Another news we read recently was lower peril man duped of 1.44 crores in online stock market scam. Again, that same issue, getting tempted. Initially, you probably make some money and you feel, okay, fine, then they will give you an app and then you download that app and the entire thing then starts and you never get your money back. So why does this happen? Why do the common man, and as you're reading other news, like 90% of people in the derivatives market are making losses. Again, these are all retail investors, retail small investors. Why should they get into these kind of false promises and all? Because this is not our job. Our job is not investing and looking at our investments all the time. We have our work. We have our work to do in the office, our business, or whatever practice we are doing. We are in marketing, so many other accounting or legal professions, so many professions. We should focus on that, and we should, improve our abilities and grow in our whatever profession we are in, and earn money. Grow our. In our position should also grow in the organization. That's what should be our focus, not focusing on quick returns or where all to invest. But there are so many products today, so much information, so many products. We are all bombarded with all kinds of information. So many, influencers and so many agents are there. So why do we get into all these issues? Why all these problems and look at so many products? So that's what struck me, that why does a common man do that, whose role or whose job is not investing? That's not his activity. So that's what got me thinking, and I thought that for the common man, what is more important is that what is our purpose when we are investing. I'm not talking about trading here at all. I'm not here into trading business. I mean the trading kind of methods and trading opportunities. About investing. So what is the purpose of investing? It's about growth of wealth, a steady growth of our wealth, preservation of our capital, and meeting financial goals. So we all have goals in life. We want to meet those goals, for which we need money. And that is the basic focus. To meet the financial goals, we have to preserve our capital. We need to preserve what is our basic capital, what is our initial capital. And there should be a steady growth of wealth, a long-term kind of a thing. However, in this process, people tend to get, common man, he tends to get tempted. He gets tempted by promises of high returns. And then he starts taking unnecessary risk in so many different kinds of, inducements and so many messages and forwards which keep coming. He gets tempted and he gets trapped into that. Because mostly the focus is what? Focus is we are focusing on returns. How do I make a quick return? Oh, this tip has come, or this message has come on WhatsApp, buy the stock. And then you look at, initially you may see 2-3%, 4%, 5% returns, but then it may not continue, because the company does not have the kind of these qualities to give that kind of return. It may not have the strength, the financial strength of the business. So focus is mostly on the returns. And if we focus only on the returns and we forget about the risks, then the results can be quite disastrous. The outcomes can be quite disastrous, and we may lose money, as we have seen with these kind of WhatsApp scams. So our objective should be stability and security. That should be our purpose or our focus, and have a very, very simple investing strategy. No complications, no multiplicity of products, no seeking too many advices, going to this person, that person, or forming a part of various WhatsApp groups, social media groups, getting all kinds of tips, etc. That should not be a focus. A very simple, straightforward, online kind of a strategy. And the focus should definitely be for the common man. I'm talking about the common person trying to create wealth, is long-term wealth creation, long-term investing, long-term wealth creation, not short-term trading, depending on tips and F&O and all these things that we are do. We should not focus on that. Try and create long-term wealth through a very simple, straightforward, simple to execute, automated kind of a strategy. That should be the focus. And if we can do that, I think our focus will not be so much on investing and where to invest, how frequent, how frequent to change the allocation. Focus will not be on that. Focus will be on our job, on what we have been trained for, what we have been educated for. We will focus totally on that and grow in those areas, and leave the investment part to work on itself in a very smooth manner. And maybe once in a while, once in 6 months or so, you can just look at your growth of your investments in a long-term strategy. Now, basically, what's the investment philosophy that we generally follow? Maximize returns and minimize wealth. I mean, sorry, maximize returns and minimize risks. That is what we generally, all of us, we practice. But what happens in this is that we sometimes emphasize more on the first aspect, which is maximize returns. We keep on looking at where are we going to get, oh, this is giving me return, that is giving me return. Somebody comes on the video on some YouTube channel and says, I did this, I got so much return, so much of advertisements and all that is going on. So our focus is on returns. Where do I get the returns? Forgetting that, high returns is high risks, and look at the risk part of it. You are earning, you are working so hard, you are earning, you're saving money, you're a young man, you've got a long career ahead of you. So look at all those things and try to build your wealth, and not get into these kind of unnecessary tricky situations, and don't take too much of risks. So focus should perhaps be a little different for the common man, for the long time wealth builder or the long time investor, that instead of trying to maximize returns, well, returns are very, very important. We cannot forget returns, and returns have to be there, otherwise what's the point in investing? But instead of focusing on that, let us focus on minimizing risk, how we can create an investment portfolio strategy where we minimize our risk. We cannot reduce our risk to zero. Risk can never become zero. It can get minimized, it can come down, and then of course you will get the returns. Once you minimize it, you'll also focus on the returns, and you will get the returns. But our objective is have a simplified investment strategy, a very simple basic investment strategy where you generate long-term returns, long-term inflation beating returns over a long period of time. We do not indulge in trading, we do not indulge in frequent exits, buying, selling, and all those things. Those are not for, that's what I feel, it is not for us, not for the common man. He should focus on a long-term investment strategy. And that is basically what the purpose of this whole thing is. Three things. First is minimize risk, simplify your investment strategy, make it very, very simple and basic, not too many products, not exiting, etc., and have a long-term goal or a long-term investment plan. Now, what is basically risk, which we sometimes tend to forget or not focus on when we are investing? It's the probability of loss. That how much loss will you make? Returns may look good, but at the same time there could be losses also. So if you have a very, very safe instrument like a bank FD in a nationalized bank, this is absolutely kind of risk, almost risk-free. Probability of loss is very, very negligible. It will not happen is what we can look at. But if you go for some other products like say derivatives or all that, that while the returns may be multiple times, but the risks are also very, very high. So what is the probability of loss? That is what we are looking at. So, and all investment decisions are risky some way or the other, except for maybe the government securities. All investment decisions carry some form of risk, we all know. But what happens is that the investment studies tell us, or the research tells us, that long-term horizon, and the long-term investing, if you're invested for a very, very long term, on a very, very long-term basis, then the probability of the loss becomes less. So the probability of the risk that you face in a very, very long-term kind of investment is much lesser than, say, a short period or a short-term investment. So Longer the term of investment, lower is the probability of facing any kind of risks. So what we need to do as a common man, as a common investor, we need to we need to adopt an investment style where we keep our risks low, we have a long-term vision or a long-term objective, and we have a strategy which is very, very simple to execute, which we don't need to look into or look at about on a daily, weekly, or even a monthly basis. We can look at it once in a while, let the strategy remain as it is, go on for as long as possible, and at the end of your, say, retirement, or after a long time, then you really get the returns and you have a solid wealth with you. That is what we are all focusing on. So now when we talk about, now we are trying to create a strategy. Slowly I will focus on how do we build this strategy, how do we build a low risk, simple to execute, long-term kind of an investment strategy, which is for a risk-averse, a conservative investor who is not looking at day-to-day trading or intraday trading and all those things. Okay. So as we all know that equities are inherently riskier than debt. So debt always has a much lower risk, mostly, not all the debt instruments, but the potential of returns will also be lower. So we are going to look at these two products, and our strategy will be based on these two products only, equities and debt, and maybe one more we will add, we will see if we require it. So we create a strategy, we combine these two and create a very low risk investment strategy, which offers a decent return over a long-term horizon. You get a decent return if you execute this very, very simple, non-problematic, you can say, to execute kind of a strategy, easy to execute strategy. So this is what our investment portfolio is going to be. We are not going to have 20, 30 stocks or 20, 30 mutual funds or so many debt instruments, nothing like that. We are looking at just 3 products, 3 or maybe at the most 4 products, that's all. That is going to be our investment portfolio, nothing more than that. And this is going to be, so these are certain assumptions. This is going to be a long-term portfolio. You're not going to go and enter today and after 1 month or 1 year or 5 years exit. We are looking at a long-term wealth creation model or a wealth creation strategy. So there is going to be no trading, no frequent exit or selling in this portfolio. You are doing it for a long term and keeping it as it is. Just 3 products, 3 basic instruments, that's all. However, in this presentation, we have not got into too much of depth of taxation and charges, etc., etc. Those we all know. We can seek advice from the taxation tax. What you call, whoever is involved in this tax part, and they can guide you. They can advise you. A tax advisor can give you details. But we are looking at just 3, at the max 4 products to complete our entire investment portfolio. So when we look at this product, when we start looking at this product, what's the first product we look at? We look at debt mutual funds. So let me be upfront with you. This is not about stock market investing. This is about investing through mutual fund, because this is for a long-term strategy. And the best way to do that is, not the best way, I would say one of the ideal ways to do that for a low-risk investor, a conservative investor, is going to the mutual fund way. And we look at the debt mutual funds. It is ideal for low-risk investors. Debt have generally a lower risk than equity mutual funds. However, they are not risk-free. Debt also has got risk. That's what we are trying to, I've been trying to say, is that we are trying to minimize the risk, not eliminate the risk, absolutely trying to minimize the risk. So we look at debt mutual funds to invest in. That will be our first product. However, as we know, there are various debt mutual funds. There is liquid funds, money market funds, dynamic bond fund, corporate bond fund, gilt fund, credit. So there are so many types of funds. Which product do we choose now? So there are so many debt funds which are less riskier than equities. Which product do we choose as our first instrument for investing? So I have selected a product which is called as income plus arbitrage debt fund of funds. Now, what is the meaning of this fund of funds? As we saw in a previous slide, there are so many debt mutual funds, so many of them, hundreds of them. Now, which one will you choose? Now, if we use our expertise and choose a debt mutual fund, we are not sure whether that mutual fund is going to give us good returns over a consistent period of time, over a long period of time. We don't know. Today it may give a good return. Next year also it may give, but the third year it may not give. So there are so many mutual funds. We don't know which one to choose. But as I said, we have very limited number of products that we will select, and that will how we create our basket. So I'm stressing is that we choose a fund of funds, a debt funds of funds. Here, what happens is that the fund manager, that is the when you put money in this fund, the fund manager goes and selects various debt mutual funds. We leave it to his expertise that you select the funds and you choose which are the funds to invest. We do not have the expertise. I'm a common man. My job is not investing and studying investments. I leave it to the fund manager. That's why we have chosen a debt fund of funds, and you can Google and you will find out the details of this fund. I've just selected one of the funds. It is called as income plus arbitrage fund. It's a debt fund of funds. Besides that, it has got an additional feature. It's also an arbitrage fund. So it is a kind of strategy where they trade between equities and derivatives. A little bit of that is also employed in this. So what happens is that you get returns of the debt fund, the debt instruments, plus a little bit of additional returns, which comes from the arbitrage component. So you have an income plus arbitrage debt fund of funds, which will be our first investment product. Our first investment product is a income plus arbitrage fund, a debt fund, a direct, we directly go in the mutual fund and we can go directly and invest in that. So we choose a debt fund of funds because this fund will go and invest in various debt funds. We leave that investment decision in professional hands. We don't try and decide which debt fund to invest among so many funds. So that will be our objective. And over a long period of time, we have seen debt funds performing well. And we are looking at, as I, in the earlier slides, we are looking at a 15, 20, 30 long-term investment plan that at my retirement, I should get a good corpus, I should get a good amount of money. That's what my focus is, nothing else, no trading and looking at hundreds of products and hundreds of. So my first product is income plus arbitrage fund of funds, which is a debt fund. While we are focusing on the debt fund, which is our first product, we cannot, as an investor, we want returns also. So we cannot ignore our returns completely. We cannot say, no, we are only going to have safe investment. We are not going to focus on the returns at all. We cannot do that. We cannot ignore the returns. However, we need to choose, an investment whether the chance of getting affected by risk or the volatility is low. So again, we are looking at a mutual fund only. And now we are looking at a second product, the second product that we will be investing in. So the first was a debt fund of funds. Second product we are looking at is an equity mutual fund. That is our second instrument that we are going to invest. So while debt gives us a lower risk, we have to also look at returns. So we come to an equity mutual fund and we invest in an equity mutual fund. Now, how do we lower risk when we are doing equity investments? The only way to lower risk when you are investing in equities is through diversification. We know that if you invest in only one stock, your risks are huge because you are hit by the entire risk that is there in the one stock. So you diversify. But as an investor, if you're a stock investor, fine, you can go ahead and you can diversify. You can invest in as many stocks. But we are not looking at investing through stocks. We want to diversify and do equity investments through a equity mutual fund. And there are various equity mutual funds, as we all know, different baskets of stocks, 30, 50, whatever. There are different baskets of stocks and different types. There's a large cap, equity mutual fund, mid cap mutual fund, small cap, thematic. So many types of equity mutual funds are there. We, as a conservative investor, as a risk averse investor, we have to choose one of the equity mutual funds among the hundreds and thousands of equity mutual funds which are available today in the market. Now, which one do we choose? The second product that we are going to look at as a long-term conservative kind of an investor, we are not going to invest in a large cap mutual fund or a small cap mutual fund or a medium cap mutual fund. We are going to look at an index fund. We are all aware of indices or the indexes. The Nifty and the Sensex are the two popular indices in the country. Like that, there are many other indices which are there in the market, in the country, like Nifty 500, BSE Sensex 500, large cap index, mid cap index, small cap index, large and mid cap. There are so many types of indices which are there. Indices are nothing but a reflection of the, if you talk about the entire market, then the Nifty Sensex or the 500 indexes are the reflection of the entire market, you can say, more or less. And then there are various categories or various sectors, etc., which are covered by these indices. So index funds, they are funds, mutual funds who invest in these index stocks only. So Nifty mutual index fund will invest only in 50 stocks of Nifty. Sensex will invest, Sensex mutual fund will invest only in the Sensex 30 stocks, so on and so forth. So these stocks, these mutual index funds, they invest only in the index stocks and they try to mimic the returns of the index. So they will give you a returns which is equivalent to the index or more or less close to the index. They are not trying to beat the index. They do not try to beat the index at all. And this kind of investment strategy is called passive investment strategy. That is what the focus of index funds is, passive investing. So for conservative long-term investors, passive investing is other than actively going and selecting stocks can be a better way to invest. So we are looking now at a second product, which is an equity product, but not direct stocks. Being conservative in our approach, we are going for a mutual fund. We are going for an equity mutual fund. In that too, we are going for an index fund. Now, which index fund do we go to? There are various index funds, and we are looking at an equity mutual fund. So we are looking at a broad-based equity mutual fund. So you can look at the, as an investor, you can look at a Nifty index fund or Sensex index fund, whatever. But what I have chosen for my investment is a 500 stock index. So I have to hide the name of the mutual fund here. You can, of course, Google and you can always find out what is the name of this index fund. And you can see there are a couple of 500 index fund stocks covering a large basket of stocks. So you're, having large cap stocks in that, you're having mid cap, you're having some small cap. So you're covering the almost 90% of the market, a very broad-based index, a very diversified index. So I've chosen that index. It's a moderately high risk because equity is never risk-free, moderately high risk. But you can see the returns over a longer period has given almost 18% return has been given by this index. So that becomes our second investment portfolio. First investment portfolio was an income plus arbitrage debt fund of funds. Second investment, which is an equity exposure, is through an index fund, a 500 stock index fund. Again, directly we go to the mutual fund. We can go to their website and invest and go for the growth options. So equity funds will definitely carry some risk, but over a long period of time, as we're talking about a longer period of time as long-term investors, this risk will get balanced, will get reduced. And if you look at this fund, which I had taken out, 1 year return is 9.6, 3 years in 18.33, 5 year is 23%, all time, if you look at the all time, maybe 10 year or whatever it is, 18.5. So I'm not saying this return is going to be consistent. I mean, we cannot predict what will happen tomorrow, whether whether a bomb will blast somewhere or no, we cannot predict anything. But looking at today, we can say that, well, this is a fund. If you want an equity exposure, let us have a diversified, basket of stocks through this index fund approach, and let that become our second instrument that we are investing in, which is the 500. So we have now two products. That's arbitrage, your debt fund of funds, and a index fund for equity exposure. However, we also have to remember, while both equity and debt have their advantages, the returns vary. I mean, there are cycles, there are ups and downs in both these products. So when the interest rates are high, you will have the NAVs of the debt mutual funds will be low. When the interest rates are going down, NAVs of debt mutual funds will increase. Equities, as we all know, there are bull markets, bear markets. So there are phases for how these funds perform, equity as well as mutual funds. And we need to cover ourselves. We need to protect ourselves against these fluctuations. So like the equity markets are now at their peak, supposing they are at their peak. And we know that after that, definitely, as the cycle always says, they will come down. So we would like to remove some money from the equity funds and put it in debt, because debt may be at a lower NAV now, it may go up. So we would like to do that. When the debt returns are high, you'd like to take some money out from debt, put it in equity. So you want to change this allocation. But since we do not have the time, our focus is not on investing. Our focus is, on our job, on our work, on our business. We need to have one instrument which will automatically do, or where the whoever is managing this instrument is going to do this job for us. So we look at an instrument which will enable us to move our investments from debt to equity, equity to debt, as these cycles keep on occurring. And that is what is the third product that we are focusing on, which is a balanced advantage fund. This is going to be our third product in our basket. And again, I have to hide the name. I have not given the name over here. I've hidden it. But this is our third investment product, a balanced advantage fund, where you have got an equity component as well as debt component in that. And the fund manager who is going to manage these funds will keep moving in and out of debt and equity, depending on where the cycle is, where the cycle of debt is or the equity is. He will do it. So you don't need to bother. Now the equity markets are too high, and I am afraid now the markets will drop and I will lose money. So let me take out some money and put in bank fixed deposits, or let me take out some money and put it in some debt fund or money market instruments. You don't need to do that. You have to rely on the fund manager. He has the expertise, he has the knowledge, he has the experience. He will do that for us. And I have taken one fund which has given 15% plus returns in the long term. Another fund, 13% return. But these are balanced funds, balanced advantage fund. They have a slight difference between a balanced fund. A balanced fund is typically between equity and debt, almost similar kind of allocation. But here you can keep on, the fund manager can change the allocation of the fund. It does not have to be in some proportion of 60-40, etc. You can change the allocation, and they have the back data has shown that these have given better returns than the balanced fund. So our third product which we have selected is the balanced advantage fund, which is a mix of debt and equity, and we depend on the fund manager to do the allocation, to select the debt fund, the debt instruments or the equity companies to invest in, and do that work for us. So what do we have now? We have the third product. First we have was the debt fund of funds for our low risk kind of an investment. Then we have the equity exposure. How do we do it? As a conservative long-term investor, not directly through stocks. We don't do trading. We don't go by tips and invest and then trade, etc. We don't do that. We choose a broad-based index strategy, 500 index fund we choose. Third, because we don't know so much about the cycles of the markets, when equity markets are at an all-time high, when debt is at an all-time high, how we can move funds from equity to debt. How do we do all that? We can't do it ourselves. So what do? We choose a balanced advantage fund. That is our third product. And now these three products are what we are talking about as our investment portfolio. Okay. So the debt funds, debt fund of funds, low risk, 500 index fund, a little bit higher risk, but at the same time well diversified over a long period of time. Due to this diversification and the longer time we stay invested, risk will get reduced considerably in this product. And third is the balanced advantage fund. That is all. This is what I wanted to project, or this is what I wanted to present to a common investor, a common retail investor. That, and when do we start investing? We start investing at a young age, when we start earning. So you build this kind of a portfolio. Don't then look at continuously at this portfolio, whether it is performing, not performing, what's happening. Keep this as a long-term portfolio, 15-20 years. Do not worry. I mean, this is going to grow as it has grown in the past. You will have the returns, etc. So this is our construct. This is our portfolio, three products. And last is the balanced advantage fund. There also you can see the returns. Again, these returns are not going to, I mean, nobody can guarantee you a return for any kind of product, but this is what it looks like. And this is our final product, a final investment portfolio. A fourth product you can add on, which I like personally, is the Provident Fund. This is a government-backed kind of a product, and you do not worry about not getting your capital back or your capital getting reduced. You have a decent inflation-beating return for a long period of time. If you stay invested, this is a good product, but not required. I mean, even for tax saving, I think the older tax scheme, not the newer one, you get tax benefit also up to 1.50 lakhs. So if you're looking at that, this is also a good product. So keep that also in mind, Provident Fund, but not necessary. So now what we have is a very simple kind of a basket, very simple basket. You directly invest, so you don't need to go through an agent. You can go through your agent also. He can also construct this for you, but you can directly go to the mutual funds website. You can start your investment. This is a low risk kind of a basket because it's diversified. It's not that you're focusing only on equity, only on debt, only on large cap, only on mutual fund. You're focusing on all the things, but through this simple strategy that we have, and it's for a long term investing. But at the same time, the questions will be how much to invest, when to invest, how long to invest, how to invest. All these questions will be asked. So these are very simple questions. I mean, you would all be knowing. So when do we start investing? There is no age. Earlier you start, the better. But typically what happens is that in India, we start earning by our mid 20s kind of, we start earning. We have some amount of money to invest in early 30s. So that's a fine. You start early 30s, but long period, wait for a longer period of time. Don't keep on, shifting investment, selling, etc. How much to start with? Whatever is your capacity. Start small amounts, and as your income grows, as your position grows in the organization, you'll have more money coming per month. You can increase that amount over a period of time, but ideally, as much as you can invest from your earnings, that is what should be our focus. Save and invest more than spend. And how do we invest? Ideal way, we all know SIP is the best form of investing. You have a system where directly from your bank account to the mutual fund, the money goes. That's it. Every week or every month, if you have even 1,000 rupees or 10,000, one day you may invest even 1 lakh rupees per week, whatever it is. Choose these three products. That is your index, your debt fund of funds, index fund, and the balanced fund. Maybe with the same mutual fund, you can do that, or multiple mutual funds, you can do that, and then start investing directly. But an SIP is the best way. Every week or every month, money goes out from you. And this is for a long-term horizon. Please remember that, very, very important. Not short-term trading. My presentation, my focus is not short-term trading, because as I told you earlier, this came to my mind when I saw my colleague, my friend of mine, getting in this trap that I want more returns, and getting into this WhatsApp groups and wasting his so much of 35 lakhs gone. That's what the main focus is. So do not panic and exit your investments based on market fluctuations. As we all know, as we are all seeing, markets will go up, go down. All this global news, domestic news, this will happen. But do not panic. Stay invested, and stay invested for a long period of time. So ultimately, what is very, very important as an investor, that we have chosen the products that we want to invest in. A very simple basket: a debt fund of funds, an income plus arbitrage fund, a 500 stock equity index fund, and thirdly, a balanced advantage fund to take advantage of the cycles of the market. These are the three products. That's all. And to that, we can add a PPF also if you wish to, but that is what it is. No other product. We are not talking about any other product. Of course, what I'm trying to say is, I'm not giving you advice that you should from tomorrow onwards change your entire portfolio and do this. That's not my job. But this is what I thought of. This is what I thought of for a common man, for somebody who is starting investing or who is past his investing. Still, you can still focus on a fewer products. I'm not an investment advisor, so don't take this as an investment advice and do this. You can always consult your investment advisor and take his suggestions, take his feedback. But this is what I thought of. But very, very important is this also: how much do I allocate? Should be my asset allocation strategy? Where do I put my money, in which fund, how much, etc. So that depends entirely on the investor, entirely on you, how much you want to invest. You've got the returns with you, the long-term returns, the historical returns, and you can choose whatever is your allocation. But ideally, to start off with, maybe 60, 40, 40, 60 index equity funds, 20 in balanced advantage fund, 20 in debt funds, or 60, 30, 10. Or if you are younger, maybe you're starting in 20s, and I would say 70, 15, 15. Why not? Look at the allocation. That's up to you, but definitely have at least 60% in equity, 20 in balanced advance, 20 in debt mutual fund. And if you do this investment, if you have this straightforward, simple, direct investment coming from your bank into these mutual funds, no need of any agent. However, if you have an agent, you have a relationship with an agent, he can construct this investment basket for you. You do that, automatically every week, every month, your money will directly go into these funds, You will have an exposure to debt, you will have an exposure to equity, you will have an exposure to large cap, mid cap, small cap. You have an exposure to everything in the market, but it's a simple strategy, simple, easy to execute. No need to constantly look at how this is performing. I don't need to do that. I stay invested for a long term, and this is for the common man, is what we look at. And you can see the annualized returns. This is done through the weighted average kind of a return we have constructed. You will get a pretty decent return over a long period of time. At the same point of time, we all know that all this is subject to an element of risk. We don't know what's going to happen tomorrow. That we don't know even with our stock investments. If I purchase stocks today, I don't know if this company is going to perform, not perform, what's going to happen in the economy, what's going to happen globally, what's going to happen to the oil prices, etc. We don't know. But if we construct this basket of just three simple products, get all the exposure that we want in the long term, we can get a decent return. And for the common man, for the risk averse, I would say, is what we should all look at, the risk part of it, not just the return, the risk part of it. This can be a very easy and a simple investment. So that's what it is, a simple, straightforward investment strategy. However, this presentation is only for educational purposes. This is not endorsing any products, any organization, or not giving you an investment advice as such. For any investment advice, do connect with your investment advisor, a SEBI investment advisor, seek guidance from him, and he will definitely guide you how to invest. This was my thinking, my thoughts, which came to me after I talked to my friend who lost heavily by getting into this WhatsApp scams and all that scam which is going on today. So be a very, very long-term investor, very long-term. Do not worry. Investment is from the money that we have saved. We have met all our requirements. We have done what is to be done for the month. Whatever we have saved, that is what we are investing, and we do not need to look into that money for a long term. So whichever money you don't need to look for a long term, invest that money, and invest is the simple products. And do not get misled by any kind of promotions, advertisements, messages promising unrealistic returns. Please do not do that, because we are at least I come from a very middle class family, and for me protecting my capital is very, very important, more than what is the return I get. So that's it. That is my simple basic presentation to you. And as we all know, this was saying by Albert Einstein, compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. So remember that if you are in the long-term investing habit, compounding itself is going to give you a very, very decent and a very, very good return. Once you have minimized your risks, you've chosen products well, don't worry, compounding and the growth of these investments is going to give you very, very good return. So that was my presentation for you for the day as part of this investor awareness program. I hope I've been able to convey some message to you, and I look forward to any questions that you might have. Thank you very much.
Yes, sir.
Yeah, any questions?
There are some actually in group Q&A section that one is asking that, sir, in investing in penny stock as long-term investment is good or bad? Means he wants to.
Absolutely. See, again, I can just tell you what my feedback is, and my feedback is, please should not go for this kind of penny stocks and low price stocks thinking that they will jump and give me 100%, 200% return. That is not our objective. Our objective is to be a long-term investor. Stay invested, let your wealth grow over a long period of time, and that is what I would recommend. Don't look at all these short-term strategies.
So the next question has been asked by Vansh Bora only. So ETF is more better in comparison of returns than a mutual fund. Is this correct?
No, nothing like that. ETF is almost like a mutual fund only. Only thing is you can trade. It's like a stock. So you can buy and sell the ETFs. So if you're looking at trading the mutual fund, kind of, you can say, I also want to trade the mutual fund, then you can go for ETFs. But ETFs are just like a stock, and our focus here today is not on trading at all. Our focus here is long-term investing. Staying invested through the mutual fund route is the ideal way, is what I would like to suggest.
Right. It's just like a personal question. Like, is the model portfolio suggested by your presentation is okay for a person of 56 years old?
So that's a difficult question. So whether now, if you're already invested in 20 mutual funds, would you now be able to change it? What we can do is that we may not be able to change it totally, that kind of, from say 30 mutual funds or 30 for so many stocks, but we can ideally reduce that, maybe make it a little more ideal, because focusing on too many investable investment products also, sometimes a headache. So we can probably look at reducing some of that, those products, maybe, exiting some of those products which are not performing well, and have a more kind of a balance, simple kind of few instruments, simple few number of instruments. But if you're a younger investors, then I would say this is kind of an ideal kind of an exposure, getting exposure to all types of securities, but in a very, very simple, straightforward manner.
Noted. Mr. Harindra wants to ask how to ensure there is no overlapping of stocks during this kind of investment.
So we have got a very simple strategy where you first you have a debt fund. The debt fund is an income plus arbitrage debt fund of funds. Okay, so the fund itself is going to invest in various debt funds, and that debt fund is not going to invest in equity. So there is exposure, equity exposure. Then you have a 500 stock index fund, that there is no overlap over there at all, because it is going to invest in different stocks, 500 stocks of different types of stocks. In the balanced fund, you could have a little bit of overlap. The balance advantage fund that you choose, you could have a little bit of overlap, but this is better than you say today you are invested in 20 mutual funds or 30 mutual funds. That is a complete overlap of across so many stocks. There's no point. You could have chosen one mutual fund or two, three mutual funds, but today you're in 10, 20, 15 mutual funds. That is what will cause more overlap than just these three products that we have chosen.
Noted, sir. Mr. Bashwaras want to ask how to handle volatility and gold silver ETF for now for the next 5 years. Now to next 5 years.
Oh, again, so this is a question which you for an investment advisor. As I told you in the beginning, I'm not an investment advisor, but I would still say that yes, gold is as a volatile instrument. Last few years, it has been giving very good returns because of so much of uncertainty, so much of volatility in the market. But at the same point of time, if you look at the very long-term returns of gold, it has been lesser than the equity markets. So again, we don't know next 20 years, 30 years, whether gold will perform. To this basket which I showed you of just three instruments, you can add some other instruments like gold or some other instruments, but this could be your core kind of an investment, and then you can probably look at other investments if you feel they're going to give long-term returns. But I would say these three is more than everything, because it is covering everything, giving a diversification, low risk. Almost everything is covered in this.
Noted, sir. Then just a comparative question, which are better with respect to bond market or any equity? And what about the ETF dividend happens for that?
Okay, so first, bond market or debt equity, that depends on you as an investor. So if you are a bond investor, returns will be low. You may get, if you look at the current returns, maybe 7%, 8%, 9%, or maybe a little more. But returns are there. But if you look at equity investment at the same point of time, the returns will be much higher as of today. At the same point of time, equity is slightly more, volatile, slightly more risky. So that's why we have taken distributed it, some amount in debt, some amount in equity, maybe 60 in the equity fund, mutual fund, 20 in the debt mutual fund, 20 in balanced. But definitely debt will give you a lower return at a lower risk.
Okay. Then Ms. Sanskriti wants to ask, how can a retail investor hedge against inflation or interest rate risk?
See, the hedging is the only way to hedge is in the derivatives market. So that's why my focus here is not about hedging or taking care of your risk, immediate risk. So hedging is also for the immediate risk. If you have facing an immediate risk, you go to the derivatives market and you can short the futures and you can hedge, or you can buy a put and then you can hedge. We are looking at a long-term investment where you do not need to have any kind of focus on hedging. The durations of staying in the market takes care of all your risk. But if you learn about hedging, then do learn about derivatives and you will understand how to hedge in the market.
Noted. So Mr. Harsh wants to ask what psychological factor one should keep in mind during the market fluctuations, like life cycles or geopolitical turnover, in order to remain optimistic during such chaos.
Okay. So if you look at the day-to-day fluctuations, every day you are seeing the markets up and down because of so much of information coming, not only domestic information, global information. Every day we hear, and this is going to continue. There is no, escape from this. This is going to continue. Maybe it will become even more volatile, or we don't know, because there is a war going on here, and so many things are going on. However, please remember, what you have to remember is, if you look at the long-term returns of the equity markets in India or most of the other countries, look at the long-term returns, 10, 15, 20, 25, 30 years return. Over a period of time, the equity markets have kept growing. It has, become, bigger and bigger in kinds of the market capitalization and size. So we do not need to worry if you are a long-term investor. And that is what I told you in the beginning. Our objective should be that. Don't look at the immediate fluctuations, immediate news. If you look at that, you will get worried. And if you are, my investment has dropped, my returns have dropped, I will exit. Please don't do that. Please just remain as long as possible. Stay invested. But as I told you in the beginning, investment is from the money that we have kept aside after meeting all our commitments in the month. Okay. So that
Right.
money I don't require for the long time. So be a long-term investor. You will not have the fear of the immediate fluctuation. That is mostly the traders and all have to take care of that.
Right. So Mr. Sudhir wants to ask for kind of investing in SGB issued by Government of India as a medium-term investment that will be considering like this only.
I couldn't get the question. Please
Yeah.
repeat.
For investing in SGBs issued by the Government of India, it will
Uh-huh.
term as a medium-term investment or any other terms we can
I
use.
think one of the things is, I'm not very sure. Please get correct me if I'm mistaken. I think the SGBs are now being kind of, I don't know,
Eradicate.
withdrawn or whatever it is. So not
Yes.
much focus is going to be on the SGBs in the long term now, in the near future now. So SGBs are, again, I would, for gold also, I would say it's a long term investments. You don't look at short term investments for gold also. SGBs, of course, they have a, I think, maturity period. I think 5 years or so. So that many years you have to stay invested, which is again a slightly longish kind of investment. So SGB also, I would say, is a long term, but not very very long term, as I would say equities investment should be for the very long term, very very long term, for getting the advantage of your compounding, as we call it.
Right. So Miss Mitu wants to ask, do you have any prescribed formula to calculate tax? Like how to calculate tax if I earn 3 lakhs in mutual fund in 3 years down the line? So any
So
calculative method for that?
so again, I'm not a tax advisor, tax expert, but that
Right.
any tax advisor will give you what is the formula. So this year again there has been some changes. So your long-term capital gains for equity is now 20%, and your short-term is 15%, up to 1 point, I think, 25 lakhs in the equity mutual funds. Capital gains is deductible, so you don't need to pay any capital gains tax. So you need to seek your advice from the your tax advisor. But today there are websites available which clearly, very nicely explain to you, if your equity mutual fund, short term how much it is, long term how much it is. Debt also there is some change, because it is either on the slab rate, or it is I think 20%. However, that is also applicable. The new changes are applicable only for exit which has happened after July, I think July 1st, 2024 or something like that. Look, so please get this checked. So there's a little bit confusion is there in terms of when the new laws are applicable. But I would request you to seek an advisor. It's easily computable. You can easily compute it yourself also if you look at the websites and get the exact amounts, whether it is 15% for short term, 20%, and how much is the exempt of 1,25,000. If you get all that detail, it will be easy to compute it also.
Right. Sir, the next question is what happens to ETF dividends? Will it grow ETF profit or not? No any
Yeah, it
effect
will
for
grow.
that.
Those will come to the mutual fund. The dividends also come to the mutual fund. So they will get added to your NAV.
Okay.
So they will also grow, yes.
Right. So this is just for the new investor. Right now, there are confusion with respect to many people are preferring long term rather than small term. So can you just emphasize on this why
Yeah,
they are
so
preferring like
so if you're a new investor, then this is an ideal time, to have a simple strategy, and not look at different various products or various messages and tips that come. Don't look at that. Have the simple product strategy, a 3 product or 4 product at the most. And this is the right time to invest. If you have got 5,000 rupees or whatever small amount, start investing 60 40, 60 20 20 allocation, or 70 70 in equity, 15 in balanced advantage and 15 in your the fund of debt fund of funds. Look at that and start investing. So for a young investor, this is the ideal time. When you're starting, uh, start investing in this strategy of very few products, directly investing, and automated kind of a thing where SIP every month goes from the bank. You don't need to do anything other than that. Once you have done the one-time bank mandate you have given for this SIP to go every month from your bank account to the mutual funds, you don't need to do anything again for your investments. That's all. You can look at those investments once in 6 months or whatever time.
So just two last comparative questions we have been asked by Mr. Shailendra and Sneha Jaisinghani. One question is like this: FDs versus debt mutual fund. In terms of long-term consideration, which should we go for?
Yeah, so FDs were almost, yeah, I would say the similar kind of returns. However, in the FDs, the taxation, even now, of course, even the taxation was almost at par, I would say. But your FD returns will be slightly lower than the debt mutual funds. So it is preferable always to go for, I mean, not, I would not, I mean, I'm not an investment advisor, but I would say that if you're looking at investing in the market, investing in corporate bonds, etc., go for a debt mutual fund. FD's advantage is that it will be in a bank which is probably a stable kind of a bank, a long-term, I mean, a large bank. So you will get your regular returns, but you'll also be hit by a higher tax amount once your tax bracket increases in the FD. But nowadays, now even the new debt fund, also the taxes also have been made similar. So I think both are almost similar today, but debt mutual fund is slightly preferable because you get a diversified exposure to various mutual funds also at the same point of time, and returns would be slightly higher in the debt mutual funds. Yeah.
Right.
Any other questions?
Just we are already complete covered the session. I'm just checking any sessions are left out. Questions are left out.
Oh, so there is one question I can read here. If someone have limited income and he
Right.
wants to invest only in one mutual fund, then which one you would choose? I think there is a a message just came. So if you have a limited income and one mutual fund, it depends. I would say it slightly depends on your age. If you're a young man, say in your 20s or early 30s, I would suggest go for a 500 index fund and do a SIP in that and stay as long as possible in the 500 mutual fund. However, if you are slightly older in your 40s or 50s, I would say you should go for a balanced fund then. Look at a balanced advantage fund, which invests both in equity as well as debt. You can look at a balanced advantage fund. If you're looking at only one mutual fund, however, it does not happen generally. But if you are just, hypothetically, one mutual fund, if you're a very young man, do invest in an index fund for a long-term investment, a 500 basket index fund.
Right. Then we have received just now one calculative question. Suppose if we have invested 10,000 monthly in an equity mutual fund with an expected CAGR of 12%. However, the fund has an expense ratio of 1.5%. How we calculate the impact of the expense ratio annual corpus after 25 years? Any strategies employee have to do for the minimize its effect?
I think the NAV which is declared looks at, I think again, I'm not expert in this calculation, I'm sorry. But I think the NAV will reflect, but the NAV which is reported to you by the mutual fund will take care of all the costs that is there, the expenses, etc., which is there. I think so. Please bear with me. And what you get in the, you get every month, I think, or something, you get a statement from the mutual fund that gives you exactly what the calculation is. That this is your quantity of unit, this is the units you have, this is the NAV, and this is the value you have. So that is probably after the deduction of the expenses, and that report will give you clearly how much is the value of investment that you're holding at present. And the CAGR will also take care of that, because the CAGR is also based on the NAVs. So that will also take care of the investments and then, the expenses, and then give you the CAGR.
Right. So one last question, one request has come from Ms. Purvi. So can we again show the return sheet of arbitrage for FOF which has been shown by you?
Return for just 1 minute.
Return sheet for arbitrage FOF.
Just 1 minute. Return for this fund, is it? This one?
Yes. So just again, you can just reiterate the things.
Yeah, so this is a income plus arbitrage fund of funds. It's a debt fund of funds where the fund manager goes and chooses which debt mutual funds to invest in, because there are thousands of debt mutual funds. So the when you put money in, say, whatever ABC mutual fund, through this fund, the fund manager will choose the debt funds, and he may have a basket of 20 or 30, 15, 20 debt, mutual fund across different segments, corporate funds, government securities, treasury bills. He will do that. Okay, so it is a debt fund of funds, firstly. And second thing is that there's an arbitrage component also in this fund. So there's a slight some amount of money which is in the arbitrage funds. So these arbitrage funds they invest in equities and derivatives, and they kind of try to generate a return which is equal to the market returns, market interest returns, slightly above the market interest returns. They try to generate that through the arbitrage methodology. So this fund will give you the returns of the debt plus the return from an arbitrage mutual fund, and the returns could be slightly higher, not all the time, but maybe slightly higher than a normal debt fund, which you can get from this income plus arbitrage debt fund of funds. And this return, which I'm showing you, is for one of the funds. There are various. This is one of the lowest ones I've taken. One of the lowest ones. There are other income plus arbitrage funds which you can look at, which have given higher returns than this. But I took one of the funds which I took for my presentation.
Right. So we almost covered the questions. Just one request has come again that can you show the chart of 500 index fund again?
Okay, I'll just show it. So this is a 500 index fund. So I have hidden the name of that fund. There are
Right.
a few funds. One thing is that these are slightly newer funds. Okay, slightly newer funds. There is a 50. I mean, the Nifty 50 index funds, Sensex index funds have been for a longer time, but now the 500 index fund has been launched, and I like this 500 index fund because this is giving a larger coverage in terms of market capitalization. Probably more than 90% of the market is covered. You have an exposure to large cap, mid cap, small cap. So you're getting all kinds of exposure also in this fund. And for the long term, this funds looks ideal for investing. And of course, the returns have been quite decent over a period of last few years. And whether it will stay, we do not know. We do not know that for any kind of investments in any stock or anywhere we do. But definitely, this is giving you the market returns. Yeah.
Right. So we have almost covered all the questions that have been asked by the
Okay.
attendees, sir.
Okay.
So I just now
Thanks.
request Sahil to take it forward.
Okay. I've given my mobile number, my mail address, my LinkedIn ID. If anybody wants to contact, you can definitely
Yes.
get in touch. Thank you very much for your patience.
Thank you so much, sir, for your thought-provoking and engaging session. We learned a lot. Thank you so much, sir. Thank you so much.
Thanks a lot.